Anyway, so the stock market sunk on Friday, and a lot of people were pretty scared. I think that I have a lot of thoughts about this. The first obvious one is that people aren't short and that they're long only, and when they see a percent or two of their wealth evaporate quickly, they kind of realize how vulnerable they are. And it reminds me of that old saying, when the tide goes out, you can see who's swimming naked. And I think that we'll talk about that more in a second, but the whole idea is that if you're not short stocks that underperform your longs, you're in kind of going to be in trouble, I think. So the Nasdaq was down, I think, 2% for the day on Friday, which is a pretty big drop after low vol. But in general, obviously, this isn't a large drop. So you can see that the drop was, when you put it into perspective, is almost not noticeable. This is a chart of the Nasdaq over, I guess, 6 or 7 years, and you can see that it's a blip, and we're still near all-time highs. So there's very little to be concerned about. Obviously, tops do happen, and this could be the top. Yesterday could have been the top. A week ago, a month ago, nobody knows. But independent of that, it's just sort of fun to keep things in perspective. And I think the most important thing here is that most people don't hedge their portfolio, including hedge funds, which is pretty funny. And I think you have to stay beta neutral. And the idea is that you can't predict the direction of the markets. And if you could predict the direction of the markets, you shouldn't really be trading stocks. You should be trading futures, and you make a lot more money than trading stocks. But I don't think anyone over really long periods of time has proven that they can actually predict the direction of the stock market. So if you can't predict the direction of the stock market, why would you want to be exposed to it? Well, the only answer there is that some people think that stocks go up over the long run, which I don't think that they do. There's this fallacy that because stocks seemingly have gone up over the long run, but after adjusting for inflation and after adjusting for taxes, and obviously after adjusting for selection bias of the U.S., I think that the amount that you're going to gain if the same thing happens, which there's no guarantee, there's really no reason to be beta or long only or beta exposed. So keeping cash and keeping shorts are two great ways to hedge any kind of portfolio insurance. Whether it's cash or shorting stocks for alpha, would mitigate. I certainly didn't have any problems, as you'll see. I had a great week investing, and that blip, which was really sudden and scary, and had everyone wondering and worrying, especially around here. There's people thinking there's going to be a flash crash. This doesn't matter if you follow my advice and hold cash or short stocks. So let's talk about investing process. So I think that this is something a lot of people get wrong. 90% of your time should be spent finding new investments, and only 10% of your time should be spent reviewing the investments you've made. And I think most beginners do the opposite. They spend a lot of time on the investments they've already made, or all their time. And it's a big mistake. I think wasting time is the number one problem with investors, in any professional or beginner investors, and I'll explain more in a second. But as I said, most of your time should be spent looking for investments that are better than your existing portfolio, so you can do a lot of things. One, obviously improve your performance, but also it sort of eases the mental anguish of having subpar positions or losing positions, so you can sort of get out and find better investments, and you're sort of in this Darwinian race to have the most optimal portfolio you can. So if you look at this list, it's a list of the biggest winners year to date. It's a very partial list. It doesn't have every stock in the stock market, but just stocks that I follow. This is a list of, probably 20, 25, 30 longs and 15 or 20 great shorts for the year. And if you haven't looked at any of these stocks, you're not making money because you're not smart enough, your method's not good enough, or your analytical ability is not good enough. You're not making money because you're just not looking at these stocks. And if you weren't looking at LOXO, I remember I was looking at LOXO with one of my teammates very closely just a few weeks ago, and we didn't pull the trigger, but we came so close. And the point is, it was on our radar, but this company, Abivax, wasn't on our radar at all. And my whole point here is that if you're not looking at these stocks, don't be surprised when you underperform or you don't have good performance. If you aren't looking at the stocks that end up being the very biggest performers, you have to rewind your process and ask yourself, well, why am I not looking at stocks like TG or Sangamo or Immunomedics or Loxo or Shopify or any of these Weibo or companies like that, Wix or Activision. Why did I not focus on these? And I think that, or vice versa on the shorts, there's plenty of companies that have dropped 50% or more this year in just this partial list. Generally this is also even more of a subgroup of a list. If you think about large moves in stocks that maybe, let's say, were up 50% and now they're only up 10%, that stock fell dramatically. So this is just a very, very partial list of large moves that you missed most likely in the markets. And I think that by far and large, the reason isn't, again, that you don't know how to do research, you don't know how to invest. It's largely because you're not spending enough time on new investments. And all of these were somewhat obvious in retrospect. Again, it's easy to say, but they were all, at least a few of them should have been in your portfolio. And if you have a 5% position in a stock that doubles, you've made 5% for the year, which has probably lifted the burden of maybe about half of your result for the whole year. So there's a lot of companies, and again, I'm not telling you to look at these stocks before or after they've fallen or risen. The point is that you should have looked at them, all of them, before the move that they made was made. Companies like Elena were relatively obvious shorts. This company has nothing going for it, never did. Companies like Alnylam were somewhat obvious longs. They have this fantastic new porphyria drug that could be very exciting, etc. Loxo was very obvious, and I was maybe moments away from buying it. So anyway, if you missed any of these stocks or all of these stocks, if you're like me, you missed almost all of them, then you have to reevaluate, your process, I think. But let's move on. I mentioned a while back about talking about Bitcoin derivatives, derivative trades, and I don't like to go backwards in my in this series, but I felt like this was necessary. Maybe the most obvious shorts here are the payment processors: MasterCard, Visa, Fiserv, First Data, and Square. These stocks could have gigantic downside, much more so than some of the prior derivative trades I mentioned. So these are the stocks to short if you think Bitcoin is going to make a lot of sense. In fact, you could probably put on a leveraged short bet that pays out 50 to 1 or 100 to 1. If we ask ourselves, will there be MasterCard 30 years from now? I'm not so sure.